The twists and turns of the Middle East topic continue, and the market continues to fluctuate around this key subject. Last week, at the final critical moment, both the US and Iran agreed to a 2-week ceasefire and negotiations, driving a recovery in market sentiment. However, the weekend consultations failed to reach any results, and the US threatened to block the Strait of Hormuz. It is expected that maneuvering around related topics will continue this week, but substantive news will likely require more time to emerge. US-Iran negotiations ended without results. Iran claimed it was due to US greed and ambition. Vance stated he has shown flexibility and sincerity and will return to the United States. Trump, if Iran refuses to compromise, the US will control the Strait of Hormuz to strike Iran's economy. Except for the nuclear issue, negotiations are progressing smoothly. The US will blockade the Strait of Hormuz. Iran will not be allowed to make money through oil sales. US Central Command and maritime traffic to Iranian ports will be blockaded starting April 13. At this stage, the ceasefire window still exists. Fighting while talking may become the norm. The risk of large-scale military escalation looms, and the Strait of Hormuz deadlock remains unresolved. All 4 directions are possible. Iran has shown strategic resilience, while the Trump administration is caught in a double pincer of battlefield dilemmas and domestic pressure. The midterm elections may become the invisible endpoint of this game. WTI crude oil suffered a heavy slump on the weekly chart last week. After a double-digit single-week plunge, a bearish engulfing pattern formed, indicating that short-term bullish strength has somewhat exhausted. However, news flow remains the decisive factor, which is why oil prices gapped higher at the beginning of this week. As the maneuvering continues, the situation of wide-range fluctuations in oil prices is expected to persist. The upper and lower boundaries are seen at the 120 and 80 levels, respectively. A clear breakout above or below these levels would initiate a new round of trends, but definitive and decisive news is the only catalyst. At the 100 midpoint level, the price is in a state where it could go either way, with a high probability of repeated handovers. Gold continued to climb last week, closing higher for the 3rd consecutive week, but signs of a stalled rally have appeared at relatively high levels. Following the heavy slump in the first quarter, the long-term trend of gold has loosened, and it may no longer be able to reach new highs. In this situation, there is a significant risk of gold prices returning to lower levels after a rebound. Technically, the struggle around the 4,800 level is critical. Successfully stabilizing above it could point toward the 5,000 level. Downside support on a pullback is initially seen at 4,400. Only a break below the recent low of 4,099 would signal the end of the rebound and the start of further declines. The US dollar plunged last week, with a shaven head large bearish candle giving back the gains of previous weeks and breaking below the upward trendline that had been in place since the first quarter. Despite this, the market remains biased toward balance in the short term, and the start of a larger trend has yet to arrive. The weekly lows at 98.49-98.52 need to be breached before bears have the opportunity to initiate further downward moves. Initial rebound resistance returns to around 100, and if it effectively stabilizes above 100.42, a potential large double bottom structure will appear, with a theoretical bullish target pointing toward the 104 level. Long-term weakness and pressure on the US dollar persist, but it is only when the market realizes the end of US hegemony that US dollar assets will encounter true selling pressure. This change may only occur after a new phase of the conflict, such as a ground war, begins. US stocks rebounded for the 2nd consecutive week with a large bullish candle last week. After returning above 65.20, the market's center of gravity began to stabilize, and bulls returned to the market. After 6,800 was retested, market focus shifted back to whether new historical highs could be reached, with the corresponding primary resistance for the SUP seen at the 7,000 level. Regarding pullbacks, one can first look at the strength of support at 67.20, followed by the 6,520 contested level. In the long run, high oil prices constitute a bearish factor for the stock market, but the reversal of market sentiment requires time to be refined. Bitcoin rebounded and then retraced last week, remaining in a pattern of low-level consolidation. The struggle around 70,000 has persisted for about 2 months. Technically, bulls must stabilize above the critical neckline resistance at 74,000-76,000 to further extend the rebound to the previous breakdown point at 80,000. On the downside, a break below the lows near 60,000 would trigger a new round of declines in the coin price. Although the risk of the curse that a long consolidation inevitably leads to a drop exists, short to medium-term news flow and the performance of other risk assets will play a major role.